What is going on, traders? Welcome back to the Traveling Trader. So the inflation story is wreaking havoc on the market. The crazy stock market drop continues, but there's good news because in this video is something that I'm going to bring to you that has been requested time and time again. I'm going to show you how to hedge your portfolio. I will show you different ways of how I hedge my portfolio in order to limit the potential bloodbath. Now, even if you're watching this sometime in the future and the market events here don't apply to the current time that you're watching it, the hedging strategies will still apply until the end of time. Now, if you want a full detailed breakdown from me of what is currently happening in the market and where I think the market will end up in the short term, watch my very last video from this one. I will link it here. However, in this one, I really want to focus on hedging strategies to limit the bloodbath in your portfolios. This is extremely important, so you'll definitely want to listen up. Even if you don't quite grasp all of the concepts, there are takeaways from this that you can go and research on your own. This is very valuable information in my opinion. All right, and if you're wondering what the hell is a hedge is just a way to reduce risk in order to limit the losses in your portfolio and even sometimes make money depending on which strategy you choose and where the market goes. And if you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you are doing to hedge your portfolios. I love hearing from you guys. All right, let's get started. So the first and obvious thing is portfolio rebalancing. When you look at corrections and pullbacks, these are perfect times to get out of shit stocks that you've been bag holding that maybe somebody convinced you to buy, or maybe somehow you convince yourself to overload on. It's the perfect time to get out of shit into quality. You do not have to bag hold that $150 QuantumScape or that $4 Camber Energy. Some of these stocks will never see those prices again, and this is just something that you have to contend with and be realistic about. So building a quality portfolio made up mostly of blue chip stocks, not overloading on any single stock. Most money managers don't go over 10%, even if they have a high conviction on that stock. And if you don't know where to start, just look at the indexes. Look at the NASDAQ, look at the S&P 500, look at the top 20, 30 stocks in those indexes. One thing you could do to gauge the riskiness of your portfolio is look at the beta weightings of each stock that you own. Here's an example from wealthyretirement.com, but if your portfolio consists of these 4 stocks and you have a $20,000 portfolio, $5,000 in each of these stocks, that means 25% of your portfolio is dedicated to one of these 4 stocks. You multiply it by the beta of that stock and you get a weighted beta measurement that then you add up and you'll get your portfolio beta. Now, how do you find out the beta? This is something that you can calculate, or you can use a service. Tons of services can find the beta of the stock. I use TipRanks for this. So if you look down here at Palantir's beta, you can see that it's a high 7.26. The higher this is, the more volatile the stock is compared to the S&P 500. So if this was your portfolio and you had a portfolio beta of 1.31, that means your portfolio is 31% more volatile than the S&P. So what you would do is reallocate into less riskier stocks or stocks that have less beta to get your portfolio beta as close to 1 as possible. In this case, this portfolio manager halved their ADMA Biologics position, and they also took $2,000 out of Cisco and put that into a lower beta stock like Next Era Energy Partners, and you get a portfolio beta of 1. Now, in my view, this is a very fundamental exercise that you should do regardless of what strategies you follow thereafter, because we're going to be talking about some complex strategies that are way more aggressive than this. Whether you choose to take those strategies or not, this to me is a fundamental step. All right, so now that your portfolio is similar to that of an index, you can hedge against the indices. So one thing you could do is buy put options against the SPY to protect your portfolio. The SPY being the ETF that tracks the S&P 500. If your portfolio resembles the NASDAQ more closely than it does the S&P, then you would buy put options on the QQQ, which is the ETF that tracks the NASDAQ. Now, I'm here on the simulated trading account in Thinkorswim. So what expiration do you pick and what strike price do you pick? Well, this is very simple in my view. You can use a very simple calculation here. You'll pick an expiration that matches the length of time you want to protect your portfolio. So let's just say that you think the rest of this year is going to be volatile, and then the beginning of next year we'll start to see another leg up. Well, in this case, you could pick the January monthly options here, January 21st, 2022. And in terms of strike price, you would pick a strike price that represents a percentage drop from the current price. So if you think that the SPY will drop, say, 5% between now and the end of the year, well, you could pick a strike price that's 5% lower than where we're at now. So right now, let's just say the SPY is at 430, 5% down would be around 409. So you could just come here and buy the put option that expires in January. One contract will cost you 1,091. Now, obviously, this is all relative to how big your portfolio is and how much of your portfolio you want to hedge. So let's just say you had a $100,000 portfolio. In this case, you're spending $2,200 for two puts, right? And that provides you protection on $82,000, which is close to your portfolio balance of $100,000 because you have two puts with the 410 strike price times 100, that's 41,000 each. 41,000 times 2 is 82,000. So essentially you're spending 2% of your portfolio for this protection. Now keep in mind that buying put options will usually be the most expensive option because you have to pay the heaviest premium in order to hedge versus some other strategies where you can incorporate selling options as well as buying them. Now another thing you could do, which is a little more advanced, is called a collar. A collar involves buying a put and selling a call. You're basically financing the purchase of that put, getting some of that premium back by selling that call. So in this case, let's stick to our example of the SPY dropping 5%. And we're going to be buying that 409 put. Well, let's just say that you don't want to spend almost $1,100 on buying this put. Well, what you can do is if you expect the SPY to drop by 5%, but you also could see that there could be a 5% upside if it goes the other way, well, you could sell a call that is 5% higher than where the SPY is currently trading. So if the SPY is currently trading at 430, 5% higher than that would be around 451. So you could then come in here in effect and sell for the same expiration the call, financing the purchase of that put. And now instead of that put costing you $1,100, it's only going to cost you $367. Now the downside here is if the SPY breaks 451, you actually cap your gains because you do have that short 451. However, again, you would do this if one, your portfolio resembles the S&P 500 pretty closely, and two, you are expecting a downturn in the market. Now, if you didn't have any stocks and you just had this position open, then anything above 451 actually loses money. But again, assuming that your portfolio resembles the S&P, you want your portfolio to go up. However, in this case, if it does go down, you still get to make some money because of this hedge. But if it does go past 451, then you will start capping your gains. Okay, and if you need to do further research on any of these things, go ahead and do it. We could dedicate an entire video to each one of these strategies, so I'm not going to go in full-fledged. Also, if you have any questions, leave it in the comment section below. I try to answer each and every question, or hit me up on the Discord if you're part of the private trading group. Sign up if you're not. One thing you want to do if you have an advanced platform like Thinkorswim, Charles Schwab's platform also has this, as well as some of the other pro platforms, is you want to check your portfolio and beta weight it against the indices. So here on Thinkorswim, for instance, you can click on beta weighting. You can pick the index that you want to beta weight against, and you can see the deltas here of your overall portfolio and how it would perform against the market. So a delta of 31.86 here means that if the SPY moves up by $1, your entire portfolio will move up by $31. However, it also works the other way. So when you're expecting market downturns, you want to get delta neutral or close to delta neutral as possible. Some really aggressive hedge fund managers as well as hedgers will actually want to be in negative deltas. That way, when the market actually goes down, you make money, because when deltas are negative, that means that you make money when the market goes down and lose money when the market goes up. However, for people who are just starting out, or for those of you who are intermediate, you will want to get as delta neutral as possible, not really delve into the negative deltas. This also helps when picking out the number of contracts. So for instance, you see our portfolio here is 31 deltas. However, when we add that single put contract, that 410 put that expires in January, you can see that our delta is near zero. It's neutral. That means if our portfolios do resemble the indices, if the indices start dropping, then our portfolios don't lose much money. All right, another thing you could do is sell covered calls against your shares. So in this case, we are hedging not against the entire index itself, but against individual equities. So let's say, for instance, you bought 100 shares of Palantir at $20. Palantir is currently trading at 24 bucks, but you do expect there to be a drop up until, let's just say, up until December. Then what you could do is go to the December timeframe and you could sell a call against your shares. Let's just say you want to sell the $25 call. You could sell the $25 call for $2.11. Now, what this means is that if Palantir does not hit 25 bucks by December 17th or doesn't expire at 25 bucks or above by December 17th, you get to keep your shares and keep the $211 that you sold that call for. If Palantir goes above 25 bucks by expiration, you'll be forced to sell your 100 shares of Palantir at 25 bucks, plus you get to keep the $2.12 per share. So effectively, your sell basis is $27.14. You could sell one call for every 100 shares that you own on any stock. Now, lastly, one other thing you could do is buy inverse ETFs. So for every index, there is an inverse ETF, meaning you make money when the index drops. Now, if you look at how these inverse ETF charts look, they look like one long downtrend because losses compound over time and markets tend to go up most of the time. So you could see here that this SPXS, which is the inverse ETF of the S&P 500, it's a 3x leverage ETF. It actually has a constant downturn since the coronavirus crash of March 2020. So you definitely don't want to hold these. These are really meant to be in and out. The inverse ETF that tracks the NASDAQ is called the SQQQ, which also is an inverse ETF that is leveraged. And in this case, it's the same thing. You do not want to hold these. However, if you do think that there are short periods of upcoming volatility, you can buy these. This is not my favorite strategy because, as you see, you cannot tend to hold these long term. However, if you bought like a SPY put, you can actually hold that until near expiration. This is almost guaranteed to lose money if you are holding it for a longer time period. However, if you are interested in this, just Google inverse ETFs. And there's an array of them. There's inverse ETFs against oil, against the indexes, against other commodities, etc. Anyway, traders, that is it for this video. I hope you got some ideas on how to hedge your portfolios. If you want access to all of our hedges, all of our alerts, link is in the description below. We've had constant hedges for a few months now. If you want to learn how to trade options, the link to the options course is below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.